This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're going to go through and just introduce share-based payments. It's IFRS 2. It's a new accounting standard, so one that you haven't seen previously in F7 or F3 for that matter. So let's go through and have a look and introduce what it's all about. So what are share-based payments? So share-based payment is a payment for goods or services. So a company may decide to purchase goods or may decide to pay an employee in either shares. Okay, now, normally we buy goods and we pay for an employee's services in cash, but it could be that we pay them in shares instead. Could be that we pay them in share options. Okay, so the option to buy a share. So we give them the option to buy a share at a particular time or point in time in the future, and that purchase price of the share will be much lower than the actual expected value of the share. So we'll give that option some value to the employee or value to our supplier of the goods. And also as well, it could be that you actually pay cash, but the cash that you pay is based on the share price. Okay, and what we see, and most of the time within the exam, although there could be the odd small occasion otherwise, is that share-based payments are commonly used for rewarding your employees. So employees will either be paid just a normal basic salary, a wage, they could get a bonus, they could have pensions that we've seen previously in the last chapter. But on top of that as well, you could be rewarded with regards to share-based payments, i.e. the option to buy shares at some point in the future, or you will get rewarded based upon the share price and a payment in cash. So the higher the share price, the higher the cash payment that you get. Okay. In terms of the scope of IFRS 2, so what does it go through and cover? If it doesn't cover any of these, then it's in a different accounting standard. So here we've got equity share-based payments. So that's whereby there is a payment in shares or share options. If there are cash settled share-based payments, that's a cash payment based on the share price. We also have potentially a hybrid of equity and cash settled. No, thank you. If we get a chance, we'll add in a session at the end. I very much doubt it, so we shall neglect that and not worry too much about it. It's never been seen in the P2 exam. I'm sure at some point it will appear. If that's the case, move on, do something different. Okay. What we've got then is we've narrowed it down, haven't we? We're going to focus on the basics. Yes, there is the hybrid, but don't worry about that. So share-based payments, there are two types. You have the equity settled and cash settled. Now, first of all, you need to be comfortable with the different terminology, the different names given to them. Equity settled are also referred to as your share options, because share options are usually granted to the employees in return for the service provided. And cash settled are also referred to as share appreciation rights. Remember, cash settled is where the company will make a payment to the employee based on the performance of the share. Okay. So, bit of detail there. Equity settled is whereby the company issues shares or share options in return for the provision of goods or services. Cash settled, the company pays cash in return for the provision of the goods or services. We need to think about the debits and credits. What's the journal entries? Well, we are going to recognise an expense, because if we're purchasing goods or if we are issuing the shares or making the cash payment in return for a service, we have to recognise an expense for the goods purchased or the service that we have used. So under both, we're going to debit the expense. The issue then is where the credit is taken to. So if it is equity settled, we are going to credit equity. So you'll be crediting equity through your other components of equity, whereby if you have cash settled, you'll be crediting a liability, because you are building up the obligation to pay cash as the share price steadily increases. So key bit. Yeah, equity settled, debit profit or loss, credit equity. Cash settled, debit profit or loss, credit the liability. That's vitally important, particularly if you're asked to prepare a group statement of financial position, isn't it? You want to make sure that you get the credit entry in the correct place. We need, unfortunately, to be happy with some terminology. So we've got a little bit of a timeline there. And what we've got there is, first of all, looking at the grant date. The grant date is today, okay, and that's whereby between the company and yourself, the employee, we agree the terms of the scheme. So we look at the number of employees who we grant the options to, or the cash settled share-based payments. We look at the number of years that they need to be employed for before they then get the entitlement to the cash or the entitlement to the share options. And we look at how many options or rights they get per employee. Okay, it's going to be more than one. It could be a couple of hundred, could be a couple of thousand. You just need to follow the information given on the question. But that's everything that we know today at the grant date. We also have the vesting date. Now, the vesting date looks at the number of years from the grant dates and looks at when the employee is entitled to the share-based payment. So when you're entitled to the share option or you are entitled to the cash. And that's the key focus of the accounting treatment, what we do between the grant date and the vesting date. There is another date, which we'll see in a moment, but the difference and the period between the grant date and the vesting date is the vesting period. Okay, and that's where we're going to focus our attention on the accounting. We then have what's referred to as the exercise date, and that's when the employer actually receives the share-based payment. So it's probably a small period of time afterwards, maybe a couple of months, whereby you actually then receive the cash, or you go through and pay the cash to buy the share as part of the share option scheme. Okay, but like we've said already, the key bits are to focus on the grant date, the vesting date, and that vesting period. There has been one question in the past that did get us to focus on the vesting date to the exercise date, but we'll touch upon that at a later time when we see it within the past exam questions. In terms of the accounting treatment, like I said, the focus is on the grant date to the vesting date, and the rules are there. We're going to go through and spread the fair value. So those infamous words in international accounting standards, fair value. So we need to know the fair value of the equity settled share-based payment and the fair value of the cash settled share-based payment, which we then spread over the vesting period, so over a number of years. And the third bit there is the important bit. It's based upon the expected number of employees. We may start off with 1,000 employees at the grant date, but 1,000 employees aren't going to still be there in 2 or 3 years' time, are they? So what we're going to go through and do there is we're going to put in a bit of judgment, and in that judgment we're going to estimate the number of people who will leave in the future, and therefore give us the estimate of who will be there on the vesting date. Okay, so a little bit of judgment brings a little bit of ethics, doesn't it? Okay, so what have we got? There's 3 things to think about. The first one is the fair value. So that will be important, and we'll see that in a moment with regard to equity settled and cash settled share-based payments. We need to look at the vesting period. So that's normally spreading it over the 3 or the 4 years of the vesting period. It's normally 3 or 4 years based upon tax reasons. And then we need to make some guesses. We don't need to make a guess. The question has the guess in. We just need to interpret the guess to be able to work out an answer. So we need to work out the expected number of employees who will be there and exercise it on that vesting date. Okay, so how many people do we expect there to be on that vesting date? We make a simple assumption that if they're there at the vesting date, then they are going to exercise it. Okay, but we should worry about what happens between the vesting date and the exercise date when we see the past exam question. Okay, so let's just focus on the fair value before we then go through and start looking at some of the questions specifically within the class notes. This just summarises the introduction within the class notes. The fair value of equity settled and cash settled, you need to be very, very careful. For equity settled, we take the fair value of the share option, not for anything else, not the fair value of the share. Yeah, we take the fair value of the option at the grant date, and we never ever change it. So whatever it is at the grant date, if it's changed by year 1, year 2, year 3, do not move it. Leave it exactly the same. The reasons why are essentially that if the fair value of the option changes, it's the employee who is going to reap the reward of that change in fair value, and therefore the standard takes the view that no further expense should be recognised because the employee has worked equally hard over those 3 years. Okay, so we take the fair value at the grant date and do not change it. So the fair value of the share option. However, be careful with the cash settled. Remember, we're building up a liability. That liability is based upon us paying cash based on the value of the share. Now, if the value of the share has increased, we need to pay more cash, and we need to show a fair presentation of that cash payment. So therefore, we need to update the fair value of the cash settled share-based payment at each reporting date. Careful. You've got to be careful there, haven't you? Equity settled, we take the fair value at the grant date and do not change it. We leave it there. However, with your fair value on your cash settled, we update it at each reporting date. So it's important that you know the different treatments and also you know the different terminology, because don't forget, equity settled are share options, cash settled are your share appreciation rights, aren't they? So you've got to be comfortable with the terminology and you've got to be comfortable with the rules. Once you know which fair value you're using, you can then go through and take that fair value, spread it over the vesting period based upon the number of employees that we expect to exercise that option. So what we'll do in the following videos, we'll start to play around with some of the numbers within some of the specific examples to do with equity settled and cash settled share-based payments. Before you do, make sure you go through what we've covered there. Make sure you're happy with the terminology. Make sure you're happy with the different types of share-based payment scheme and that you're happy there with those rules about what fair value you use for the two different types of scheme. First of all, we're going to go through, following that introduction, we're going to go and look now at your equity settled share-based payments. Now, remember, with your equity settled share-based payments, what we have there is the journal entry is that we debit the statement of profit or loss and we credit the equity. And when we're working the amounts to be shown in the financial statements, remember, we're looking at spreading the fair value over the vesting period based on the number of employees that we expect to exercise the option. And the key bit, isn't it, with regards to your equity settled, is that we take the fair value at which point? Excellent. Yeah, we take the fair value of the share option at the grant date, don't we? And we do not change it. So let's go through there and have a look at the first example. It says there, prepare extracts to be shown in the statement of profit or loss and the statement of financial position for each of the 3 years. So not just for 1 year. So is it there for the 3 years from December 2015 all the way, is it there, to December 2017? Okay, so 15, 16, 17 are 3 years. So when we're looking there at the extract from the financial statements, we need to go through there, don't we, and think about the statement of financial position and the statement of profit or loss. And we need to look at it there. Is it for the year ended 2015, 2016, and is it 2017? Okay, so 15, 16, 17. There we go. Okay, excellent. And what we need to do as well, don't forget, is that within the statement of financial position, we're looking there, is it at equity, and then is it an expense through profit or loss? Okay, so if you get your pro forma set up, you're doing quite well. So what it says there is, it says Bree granted 10,000 equity settled share-based payments. So as soon as we know it's equity settled, we go through there and focus, don't we, upon the fair value at the grant date. Okay. We granted the share-based payments to the 20 directors. What we'll see in this example, to keep it simple, there is no change in the number of employees, so it sticks with the 20. The options vest on the 31st of December 2017. So 15, 16, 17 is a 3-year vesting period. None of the directors will leave, as we stated, over that period. And then you're given the fair value of the option. That's important. It's the fair value of the option. And you're given 4 figures there. Now remember, if it's your equity settled, we need to go through there and take the fair value, don't we, at the grant date. So even though I'm told what happens to the fair value of the option at December 15, I ignore it. December 16, I ignore it. December 17, I ignore it. Yeah, I use the fair value at the grant date, which is there as $12. Okay. So I apply that over the 3 years to the 10,000 options, and is it the 20 directors? So what we've got there, in the first year, to work out the figure on the statement of financial position, we've got there, is it 10,000 options, fair value of 12, 20 directors, and we are at the end of the first year of a 3-year vesting period, aren't we? So 10,000 times 12 times 20 divided by 3, that goes through there and gives me an equity figure of $800,000. In terms of what the expense is, the expense in this instance is going to be the same at 800,000 because we started off at 0 in terms of recognizing any expense and any equity balance at the start of the year, and it's now up to 800, isn't it? So we credit the equity with 800, and the other side of the entry is the debit for 800 as well. Okay. There's no change in the fair value in terms of the grant date, so we stick at 12. There's no change in the number of directors. So in the second year, it's still the same 10,000. We still multiply by 12. We still multiply by 20. But at the end now of the second year of the 3. So remember, the SFP is a cumulative financial statement, isn't it? It shows you at a point in time. So we are at a point in time that is 2 years out of the 3. So 10,000 times 12 times 20 divided by 3 times by 2. We are now there, is it, I think, at 1.6 million. Okay, that's the equity figure that would appear within your other components of equity, if you like your shares to be issued in the future. Now, we've just got to be very, very careful in terms of the journal entries, because we are looking, aren't we, at the movement from 800 to 1.6 million. So to get from an 800,000 credit to a 1.6 million credit, we need to process another $800,000. So we've credited the equity and debited the expense with the 800,000. So when you're looking at what goes to profit or loss, it is the movement on the equity figure that goes to profit or loss, isn't it? Okay. Third and final year, not too much really to put in. I think you may already be ahead of the game as it is. But 10,000 times 12 times 20 is that 2.4 million, isn't it? So my equity balance is there at 2.4 million. Again, that's what the SFP figure needs to be. To get there, we need to process a journal entry that looks at the movement, isn't it? And the movement from 1.6 to 2.4 is another $800,000, isn't it? Okay. So remember, when you're looking at your statement of financial position, that's always at a particular date, isn't it? And the statement of profit or loss is for the year ended. So it looks at the story that's happened for each of those years, isn't it? On the SFP, it's all there cumulatively. Key bit that you've got within that question is that right the way throughout it, the expected number of directors did not change, did it? We granted the options to 20 directors, and those 20 directors were expected to stay for the next 3 years. In the next example, what we're going to go through and do is we're going to go through and look at a similar scenario, ever so slightly different numbers, but in that similar scenario, there are changes in the expected number of employees that are going to exercise the option. So here, again, similar requirements. It wants us to prepare extract from the statement of profit or loss from the statement of financial position for 2 years ended December 14, and is it there December 15? So it says here on the 1st of January 2014, EDAM granted 20,000 share options. So we are looking at equity settled share-based payments to each of its 10 directors. The conditions attached to the share option scheme is that the director must remain an employee of EDAM for 3 years. So again, we have a 3-year vesting period. And the fair value of each equity settled share-based payment at the grant date was $60. Okay. At December 2014, it is estimated that 4 directors would leave before the end of the 3 years. And then at December 2015, due to a downturn in the economy, it's now an estimate of 1. Okay, so therefore there is a change based upon the number of directors. So what we have there, once again, statement of financial position at a point in time, statement of profit or loss for the year ended, and I think it was there for 2014 and 2015. So remember, the key thing to work out is when you're looking at your equity settled share-based payments, is that on the SFP you have equity, and in profit or loss you have the expense, and the expense is equal to the movement, isn't it? I can't emphasize how important that actually is. Okay, so what have we got within that first year in terms of our calculations? We had, is it 20,000 share options, $60, 3 years, and 3 are going to leave. So 20,000 options, $60 fair value. 10 were there at the start, we were expecting 3 to have left by the end of the 3 years. Again, we're at the end of the first of a 3-year vesting period. So yes, it was, oh careful, 4 directors. So let's just go through there and make sure that we don't make any daft mistakes there. So we have 20,000 multiplied by 60. 10 less 4 is 6, so multiply by 6. Divide that by 3. Gives me equity, is it there, of 2.4 million. Again, in the first year of the scheme, the movement isn't too exciting because that is just exactly the same as what we have as the value of the equity. Okay, because we've gone from 0 to 2.4 million. In the second year, 2015, we still have 20,000 options. Fair value is 60 still, that never changes. There were 10 directors there, but now we only estimate that 1 director will go through there and leave. We're on the SFP, so as at this point in time, we're at the end of the second of the 3 years. So multiply by 2/3. That should go through there and give you an equity figure of 7.2 million. If we're going through there and looking at the figure on the statement of profit or loss, remember that is the movement, isn't it? And the movement is there as 4.8 million. So in the second year, you're crediting the equity with 4.8 million and debiting the expense with the 4.8 million. There we go. So the focus upon that there is looking at the expected changes within the number of leavers that there are within that scheme. Here it specifically said we expect there to be 4 to have left by the end, and then specifically 1 to have left by the end in that example there. Okay, that's the tricky bit within any of these questions. It's always difficult, whatever the examiner gives you, to try and go through and interpret what you have with regards to the number of levers. Okay, that example may be a little bit too straightforward, but nonetheless it's something to go through there and start thinking about. Okay, excellent. Those previous 2 examples went through there and looked at calculations that involved services and share-based payments, being equity settled share-based payments. The following small example just goes through there and looks at transactions involving goods. Okay, so you are purchasing goods, and in purchasing those goods you are issuing share options. Okay, the key bit there is that when you're looking at the fair value, we take the fair value of the goods. We worked out the fair value of the services by looking at the fair value of the share option, which was given to us within those questions. Here, the key bit is that you take the fair value of the goods. Okay. So it says, explain how the transaction should be dealt with in the financial statements for December 2015. So here, Caerphilly purchased inventory at a cost of $10 million and we sold them in November. So there's a profit on the sale of $4 million. It says Caerphilly had cash flow problems during 2015 and negotiated with its suppliers to exchange the goods for options on its shares. So what you have here is, instead of just a standard credit purchase, you have the purchase of goods in exchange for options on your shares. So when you're looking at the journal entry, you are debiting your purchases, crediting not payables but equity, and your equity under that shares to be issued category is part of your other components of equity. Key bit, once again, is that we need to look at the fair value of the goods. They are there at $10 million. Do not be put off. There's a red herring. There's something to divert your attention. Yes, the shares had a market value of 11.5 million. We're not worried what the shares were worth. We are exchanging 11.5 million worth of options for goods costing $10 million. So we're incentivizing our supplier to take the shares, knowing that they're selling us $10 million worth of goods, but they're getting something in return that's worth that little bit more. Okay, so we are going to record the purchase. We're going to record the purchase based upon the exchange of the goods given up, and the fair value of the goods given up was the $10 million. If that's the case, we are going to debit purchases with 10 million and credit your equity as shares to be issued at that $10 million. That's it. The key bit is, remember, it's the fair value of the goods or the fair value of the services. It's nothing else to do with anything that could be thrown at you within the questions. Other than that, that's it in terms of looking at your equity settled share-based payments. Have a work through those questions again, make sure you're happy with them, and then we'll pick it up again in the next session by starting to go through there and look at your cash settled share-based payments.